I mean, the numbers on Anthropic are crazy.
Yeah, was it 2 trillion, they think? 2 to 3 trillion?
2 trillion valuation, but like, they were the revenue was annualized at 10 billion at the beginning of the year.
Yeah.
It's now 50, 60 billion, whatever it is. It could be 100 billion at the end of the year. And if it keeps going at that rate, it'll be $1 trillion annual revenue by the end of next year.
That's wild.
Which, you put that in comparison, Amazon and Walmart, which have the two largest, I guess they have the largest revenue of any publicly traded companies, are at about 700 billion.
Wow.
So either it's going to be the biggest company ever, or there's going to be some serious disruption at some point here in the next 24 months. I know what I'm betting on.
I think we should start referring to the heads of big technology companies by their first names like we know them. Well, I talked to Dario the other day, and Elon doesn't agree with my sentiments on this.
Welcome to the weekly edition of the Payne Points of Wealth podcast, the podcast that addresses all the pain points that come along with creating, growing, and sustaining your wealth. Hosted by the family wealth experts of Payne Capital Management, Bob, Ryan, and Chris Payne. Please send us any questions or comments you may have to questions@paynescm.com. And please enjoy this week's episode.
Yeah, so I think the big question is, we've seen this, we'll call it a re-rotation back into semiconductor stocks, right? They had a big sell-off in July. We had one hedge fund basically melt down because of big bets they made on semiconductor stocks. Apparently, like 1 in every 20 adults in South Korea had a margin call last month. So speculation was rampant. But now this month, you're getting this big rotation back into these stocks. So Bob, you've been in the business for a while. You've got a couple scars on your back. Where do you think this is going? Do you think the semiconductor trade's back on? Magnificent Seven is starting to run up again. If you're reading the tea leaves right now, where's it going?
Well, I think that the one comment that I'm getting from everybody, whether they're a client or a friend or a family member, is that, wow, this market's unbelievable. Can it keep going? It's like, is this for real? When is there going to be a correction? It's going to end ugly. But, right now, even though we're only in 2026, it's the 6th best decade of stock performance since the roaring 2020s. And if we do hit 10,000 by 2030, which we kind of think we will, then it'll only be the 5th best decade. So, exceptional decades for the stock market aren't the exception. And this one still has a way to go to catch up. So I think it's going higher, guys. And I think that it's all about AI, right? Who would have thunk that commodities are an AI trade?
Well, no, it's a good point, right? I mean, the reason that you have copper at an all-time record high right now, Chris didn't tell me steel prices were going to go through the roof this year. If he did, I'd be a rich man right now.
I just forgot to hit send. Sorry about that.
But there are these unexpected places that are benefiting from this whole AI infrastructure build out, right? That's where a lot of the resources are going. And to your point, Bob, I think it's a little deceiving when you talk about this decade, because if you look at the S&P 500 specifically, let's face it, it's been running up since the great financial crisis, right? So around 2009, 2010, that's really when growth stocks started to take off. Now you had this pandemic, around 2020, which was a little bit of a hiccup. But if you start looking at the returns on the S&P 500 going back like the last 15 years, we were averaging 15% a year. The stock market averages 10% on year on average. Longer term, I have to think that you are going to get some mean reversion here at some point. Maybe we're not there yet, but these are well above average returns if you've been a stock market investor for over the last decade.
Well, if we get to 8,400 by the end of the year, this will be the 4th consecutive 15% return for the S&P, only exceeded by the late 90s, where we had 5 consecutive years. So, it does remind me a lot of the 90s, where you're seeing a melt up in the market being led by tech stocks. Now, different this time is these tech companies have earnings, they have revenue, and they're spending like drunken sailors. So I don't know. It's just like, are they forcing the results? Is the results going to be good no matter what because they're spending all this money? What do you guys think?
Well, I'm going to push back on that first. They're not all profitable. If you look at SpaceX, Anthropic, OpenAI, they lost $25 billion last year. So that's not necessarily true. And also, now you have these hyperscalers like Amazon, Chris. You have Facebook or Meta, whatever it's called nowadays, Oracle, all these companies are taking on massive debt to keep funding this whole AI boom. It's starting to look a lot like the 90s, where these companies aren't as profitable as they used to be.
No, that's a good point, Ryan. Actually, I was talking to a client of mine yesterday, a client that is traditionally very conservative, always talking about how we can reduce risk in the portfolio. And one of the things they pointed out after looking at their performance report was that their equity portfolio was up 300% since inception, but the portfolio itself was only up 160%. And their comment is like, well, why don't we just take a little bit more risk and get some more of that 300% in the portfolio? So if that's not a sign that people are overly enthusiastic, I'm not sure what is.
They definitely are getting more overly enthusiastic, Bob. But I want to go back to your point as well. You think this bull market is going to continue. If I'm an investor right now, well, you think AI is everything, then why don't I just put all my money into semiconductor stocks and into the Magnificent Seven? Because that's a lot of people's portfolios anyway. That sounds like a pretty easy no-brainer. Heck, I don't even need to hire you as my financial advisor, Bob.
Well, because the market has done what we expected it to do. It's broadening out this year. So if you want to underperform, follow that strategy, right? But if you want to get better performance and better yields with better price, then you have to invest in international, emerging markets, value, commodities, pipelines. I mean, they're all outperforming the S&P over the last 2 years. So you don't want to be all in one. It's a hard reminder that from 2000 to 2010, the average annual return on the S&P 500 was zero. That's 0% for 10 years. That's a harsh reality, to face when you're sitting there thinking like these 15% annualized returns are going to be forever.
I also have to point out too, and I don't want to gloss over this. Ryan, you talked about that hedge fund that went out of business. They got a margin call. First of all, the irony of the name is that the hedge fund was called Situational Awareness. The other thing is, it just kind of shows you how crazy things have gotten. Not only did they invest in only that one thing, but they were heavily leveraged. So it's kind of hard to believe that in a market this good, you're actually getting a margin call.
Well, the truth of the matter is, Chris, they didn't go under. They had to sell off the majority of their portfolio. He's still in business, and actually people are like trying to throw money at him, and he's turning money away.
Even now? That's crazy, if that's the case.
Even now.
Well, wait a minute. Worst case scenario is that Ken Griffin will buy you out, so you always have a backstop.
Well, first off, I think he only owns his private investments, which we don't know their value at. This Leopold Aschenbrenner, I think his name is. But I think there's an old saying, Bob. There's old pilots and there's bold pilots, but there's no old, bold pilots. And I think that's apt here. And you have to remember, too, is the returns from inception are still like astronomical, but most people probably got into that fund in like the last 6 months. So most people probably just got basically destroyed with their portfolio. And that's what you forget. We talk about Bitcoin too as another example of this, is the average investor got into Bitcoin around 50, 60,000, where the price is today. But everyone talks about, well, since inception, Bitcoin has dramatically outperformed the S&P 500 over like 10 years, how long it's been around. But that's very deceiving because most money doesn't come in at inception, right? It comes in after it's already hot. And that's another reason why most people, when they put their money with these professional managers or into these esoteric asset classes like cryptocurrencies, is they tend to get in not at the beginning, but somewhere closer to like where the top is. And I think that's one of the things you have to think about as well when it comes to some of these hot fund managers that never stay hot forever, Bob.
Well, that's the beauty of it, because a lot of folks think you just look at a chart. I don't look at it. It's going from left to right and a 45-degree angle to, from the bottom left to the upper right. But, one of the bigger bulls on crypto, who's been banging the table for years, said it was fine at 120,000, but then he stopped out his own portfolio at 68,000. Now he's bragging about it. And I'm so happy to be out of crypto. I'm like, well, all that work you did charting that investment, you end up making no money after 5 years. And the same token, won't put money in the stock market overnight because it's too risky. I mean, it's just, you can't make this stuff up.
Well, look at the bright side. He didn't lose any money.
Yeah, something called opportunity cost, right, Chris?
Yeah. Meanwhile,
we do have a big booming bull market, but not everywhere. Right now, the bond market has been selling off around the globe. So you're having interest rates. We got a 2-decade high yield in 30-year treasuries. You got a 15-year high in the German bond. So interest rates are rising globally, which, is a big headwind, not just for the stock market, but specifically long duration assets like growth assets. So if these rates keep going, you're going to see a much bigger correction in the tech sector than we've ever seen in the last year or so.
Hey, hope you're enjoying the most recent episode of the Payne Points of Wealth podcast. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million for your retirement, Bob, Chris, Courtney, and I will run for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We'll go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life and hone in on every financial issue you need to address today, whether it's an income plan for retirement. How do you take Social Security? How do you draw from your portfolio, factor in inflation, and don't run out of money? We'll look at diversification. Markets have been wild over the course of the last couple of months. Has your portfolio been up and down? Or have you been sitting in cash, CDs, money market funds, paralysis by analysis? We'll put together a full investment game plan. We'll show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, insurance product, structured product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get a full tax playbook, and we'll do this full review at no cost. We'll literally go through everything for you, do all the work up front. Simply go to www.paynescm.com/financial plan or click the link below to see if you qualify for a free financial review. This is a good point. And I think this is what you're saying, Bob, if I hear it correctly. I think short term, it's almost like everything's going to go up right now, right? The tech trade's hot again. To your point, international stocks have been outperforming the U.S. for the last 2 years now. No one's talking about that. Energy stocks are going through the roof for a lot of reasons. A lot of it has to do with that Strait of Hormuz, which we can't get open. So broadening out your exposure has been very, very smart here. But I think you're right. Longer term, there's a couple big questions on investors' minds right now. The first one is, we clearly have inflation, right? We've been waiting to see inflation come down. The Fed, we're wanting to find out if they're going to cut interest rates or going to keep interest rates the same or raise interest rates. That's a big question on investors' minds. But if we look at that 10-year Treasury at 4.7% as we're recording this, and the 30-year at 5.2%, which is like, what is that, a 20-plus year high, Bob? Correct me if I'm wrong.
Yeah. Yep.
The bond market's telling you that we're going to have more inflation. And that's really important when you actually look to allocate your portfolio right now. Because to your point, growth stocks and tech don't do that well when you have real inflation. So longer term, maybe tech isn't the place to be.
Well, I think that they're all good points. And are interest rates going up just because of inflation? Is it because of the sticky oil-based inflation? Or is it the hyperscalers and all these AI companies that are borrowing aggressively, from the bond market, kind of crowding out the government markets, right? Especially the U.S. Treasury market. And the U.S. Treasury market is always the benchmark. So if our rates are going up, it impacts every sovereign bond, every corporate bond, every investor around the world. We're still the go-to place, for safety, both the dollar and the U.S. Treasury. So, if all this borrowing pushes the cost up in our country, it's going to push costs up around the world. So that might be the other reason we're seeing rates go up.
Does that become self-perpetuating? I mean, continued borrowing, continuing the rates to go up, that hurts the bottom line eventually. Does that self-perpetuating process, kill technology?
I mean, at some point it has to, right? And if it has to, if borrowing rates go up, and let's face it, if you have a lot of these companies now trading for 50 times, 100 times their sales, you're paying for that up front. Well, the higher rates go up, the less valuable that longer term revenue is in today's dollars, right? So that is going to become an issue at some point. Now, to pick the top on that, Bob, unfortunately, my crystal ball broke like 25 years ago when I got in the business. But at some point, Wall Street's going to change their view, and they're going to become very concerned about profitability. They're not going to care about sales that are 100 years in the future. So that's why I think it's good to be proactive with your portfolio right now, not reactive. Get re-diversified now. Don't wait. because we're not going to know when that change is actually going to come.
Yeah, and I agree with that, right? Because I think the underneath all this, you have this booming economy, right? We're looking at GDP Now's prediction of 4% GDP growth for the quarter. Now, arguably, it's down from 5. We just came off a phenomenal quarter of earnings, greatest earnings season ever. And when you look at all the earnings estimates, not just for the well-known blue chip stocks and growth stocks, but mid caps, small caps, international stocks, all those earnings estimates are hitting all-time record highs. So the analysts are actually increasing their earnings for 2027, not decreasing. So you have a lot of resiliency in this economy. So it's kind of like this: are earnings going to drive the market higher than inflation's going to knock it down? It's going to be that great battle, between the equity bulls and the bond vigilantes. So I'm going to put out a nice article about that.
Yeah, no, I think you're right about that. And also, Chris, I think we talk about this on the podcast a lot, is the consumer does drive the economy, right? And now AI spending is driving the economy too by these big hyperscalers or hyperspenders as well. But I think we've been seeing this, and you see this with your client base a lot too, is people complain about higher prices, yet they still continue to spend money. And that's what the data is showing us as well.
Yeah, I mean, that's definitely true. I can tell you one area where I'm starting to see that not become true is the real estate market. I've noticed that, there's inventory coming on the market. A lot of stuff is sitting on the market, and we're starting to see prices come down a little bit. So I think, with the combination of interest rates going up, and the fact that home prices are, have climbed so high, you're just not seeing the market there like you were before.
Bob, and I know you're down at the Jersey Shore there, living the good life. We all wish we were down at the Jersey Shore like you. Are you seeing any softening in prices there, where prices have just skyrocketed over the course of the last couple of years?
Actually, the real estate values continue to go up. The prices continue to increase. And I think the unintended consequence of that is the rental charges have increased. And the rental season was one of the worst this year. I mean, it was way down from the last 2 years. There was a good article in the Inquirer last year, Philadelphia Inquirer, and it was called "The Caribbean, Paris, or the Jersey Shore, which is the better deal?" And you look at the cost of renting a house on the beach in Ocean City is like $15,000 to $20,000, or in Avalon, $20,000 to $25,000.
Wow.
Chris, you could probably find a nice Airbnb over in Paris if you could get a decent airfare. Might be a better deal than coming to the old Jersey Shore.
What's the old saying? What sobs higher prices? Higher prices. And maybe that's the tipping point you're getting to now, where at some point prices just get too high. And I wonder then, the slowing of the rental market, is that a precursor to softening in real estate prices? And my guess is it probably is, right? Because when you start comparing what the valuation of a house is, you typically have to compare it to what you could rent it for on a monthly basis. And if rents are starting to soften, my guess is here you have to get some sort of softening in the real estate market. Prices probably have just gone too high without any recognition for the fact that mortgages, now are at a much higher rate than they were just a couple of years ago.
I don't know. I just think that we're having this unbelievable wealth effect, right? You have individuals whose personal investments in real estate are at all-time record highs. Their portfolios at an all-time record high. There's a lot of companies being bought out by PE firms. Corporations are making record earnings. So, and the baby boomers, control half of the wealth of this country. If you add their parents' generation, some few of them are still around. It's almost like 5/8, almost 3/4 of all the wealth is in their hands. So, they're not afraid to spend it. And so I think that there are people who are sitting there thinking, well, I always wanted to have a place in Florida. I always wanted to have a place at the shore. Yeah, who cares what the price is? I got more money than I ever had in my life and can't take it with me. So there's a little bit of that going on as well.
Yeah, no, I totally agree with that, Chris. Are you seeing that with your clients as well, that they're looking to buy because their portfolio's up, their ability to spend has gone up as well?
Yeah, definitely. I mean, I've definitely had some clients, especially over the last year, buy some pretty high-end real estate. But interesting enough, they actually had to sell properties to buy their new places, and they actually had a hard time selling a couple of their properties.
That is interesting. Yeah.
If they sat in the market, whereas like a couple of years ago, maybe something sat in the market for, a month, maybe a couple of weeks. Now it's a couple of months and prices are coming down.
I always love it when I sit down with a client, they talk about how much money they made in real estate, but then I remind them about the million addition they put in, the cost of all the utilities that they paid, the landscaping. I don't know if you guys remember old Fred used to do our landscaping back in Gwinnett Valley. He was actually a retired orthopedic surgeon. He quit being an orthopedic surgeon because it was paying him more doing landscaping. At least that was my joke at the time.
I don't think I saw Bob ever mow a lawn in my entire life.
Hey, listen, I taught you guys well. Just appreciate it.
Why do it when you can delegate?
Yeah, I think bottom line here is, Bob's generation, the baby boomers, they're going to drive everything as usual, right? They're all retiring. They've got $80 trillion of net worth. That's half the net worth of all Americans in baby boomers' pockets. And we forget the fact that interest rates have gone up just increases their income for all that money they have sitting in money market funds, giving them more discretionary income to spend. And what we're seeing is not only are they going to spend on healthcare, travel, but they're giving it to their grown children. Hint, hint, Bob. One of these weeks, he's going to get the message, Chris. They're going to help fund their grandkids' education. They're going to help their grown children out with all their different expenses. That's going to be a big driver of the economy for years to come. You can't discount the baby boomers, the greatest capitalists of all time. They've lived long and prospered, just like Dr. Spock told them that they should. And I think that's going to be a big part of the economy that we need to be talking about moving forward.
Thanks for listening to the Payne Points of Wealth. Hopefully, you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.